understanding of financial markets was to understand and to explore together what the impact of this coronavirus crisis is on valuations and the market at large. Specifically, we want to understand how does the crisis inform the values that we see in stock markets? What is that we can learn about the crisis from financial markets? And also, and why not, how can we actually protect our financial wealth as well as construct resilient portfolios that can withstand this very dramatic and tragic crisis that we're experiencing? Now, before we start by analyzing the particulars of financial markets, let's just remind ourselves of the three things that are interacting in rich ways: the public health crisis, the state of the economy at large, and of course, financial markets. Now, whenever economists, and in particular financial economists, talk about the economy and financial markets, they can sound cold-hearted and a little bit detached from this tragedy. Of course, the objective is always to solve this, tragic public health crisis and to address the anxieties and fears we're all experiencing on account of this. So don't take the coldness of some of the things that I'm going to be saying in the lecture that follows, but simply try to incorporate it into your analysis on how to approach our current predicament. So on the public health crisis, of course, we have many questions. How bad will this get? Will our health system have enough capacity if the severity of the crisis gets worse? The second is, of course, the state of the economy. How deep the contraction will be? What will be the shape of the recovery? Will it be a U-shaped recovery? Will it be an L-shaped recovery? Will it be a V-shaped recovery? And second, what will be the policy reaction? How do we have to think about what the government is going to do in order to address the many challenges that we're experiencing when it comes to this crisis? Now, financial markets have a very difficult role to play because they have to put all this together. They have to understand the evolution of the health crisis. They have to understand the evolution of the economy itself, the policy reaction, and more than that, they have to some extent, forecast how these things are going to be playing out in the months and years that follow. So I want to actually treat all these things, do it as systematically as I can. And the plan of this talk is to discuss the reaction of financial markets broadly understood to the coronavirus crisis, and then do something fun with all of you, which is to actually look at the valuation of a couple of companies and just to show you some of the things that we're discussing with the students in the context of this tragic crisis. So we all know, and we all have seen these very sad plots. It tells you essentially the number of deaths and cumulative deaths in red in the many countries that have been exposed to this terrible virus. There you have Italy, the epicenter over the last few weeks of the coronavirus crisis. China, the first country to experience it. My home country of Spain, sadly becoming the second epicenter of the coronavirus crisis, and finally the US in the earliest stages, and following, sadly, a similar path to the one that Italy and Spain had followed in years before. This is the state variable, so to speak, that captures the state of the public health crisis that we're suffering. Now, of course, the market reacted to all this. In this plot, what you can see are the daily deaths, fatalities in the United States, plotted again the evolution of the S&P 500, which has to be read off the right-hand side axis in your plot. Now, as you can see, the market reacted before the crisis, the public health crisis, got going in earnest. And the reason, of course, has to do with the fact that the market was following closely what was happening in other parts of the world. So there you have the same evolution of the S&P 500 since December 31st, 2019, when we first learned of the severity of the crisis from China, plotted against the cumulative fatalities in Italy, Spain, China, the United States, and South Korea. So far, the country that has most successfully avoided the extreme realization of fatalities that we've seen in other places, in particular Italy, Spain, and sadly as well the United States. So as you can see, the market was following to some extent closely, even though it reacted late, as we will see shortly. As always, when these crises, they are slow in coming, but when they come, they happen fast. Now, as you can imagine, once the reaction came, different sectors reacted differently. This is not surprising. The crisis does not affect all sectors equally, and the market, being irrational in many situations, well, is not completely crazy. Some sectors like food and supplies retailing reacted very positively on account of the fact that a lot of the demand was accelerated when people panicked and started going to grocery stores in order to build the buffers in anticipation of the long shelter in place that the public health measures would require. Other things like automobile and components fell on account of the fact that very clearly the demand was going to be delayed. Finally, energy is peculiar because contemporaneously to this terrible coronavirus crisis, there seems to be a price war between Saudi Arabia and Russia for the control of the oil market and pricing in that particular market. So the first thing to understand is that the market reacted as it should. We're going to learn more about how the market was processing information, but not all sectors reacted equally. Some sectors, in fact, experience positive returns on account of the acceleration of demand the crisis was bringing about for those sectors. Now, how can we learn then about the evolution of the crisis? This is the moment to be imaginative. As I will argue shortly, there's a lot of things that we can do in order to track a little bit the behavior of the economy. In fact, such is the richness of data at our disposal these days that you can actually even follow the evolution of the crisis on a daily basis. Here's an example of how you can do that. You have a plot here of the travel numbers for the month of March, both for 2019 and 2020. In yellow, you have the numbers for the year 2019. In red, you have the numbers for the year 2020. On average, throughout the month of March of 2019, between 2 and 2.5 million Americans took to traveling on an average day. As you can see, the number of people traveling during the month of March has collapsed. We have daily data from the TSA, the Transportation Security Administration. I've plotted yet again the evolution of the S&P 500 during the days, during the trading days of March of this year. And as you can see, the market seemed to turn even before we achieved the minimum in terms of traveling arrangements for the month of March. As always, the market is forward-looking. It may get things wrong. It may discount some of those values more than they deserve. But roughly, the market seems to be reacting largely in a reasonable way to the tragic events that we're experiencing over the last month or two. Now, you can learn as well from history. So sadly, this is not, of course, the first pandemic we have experienced. I'm sure many of you have heard of the Spanish flu of 1917 to 1919, roughly. That was a terrible pandemic as well. It coincided with the last year or two of the First World War. It's called the Spanish flu, not because it originated in Spain, but rather because the Spanish press was quick to report that something was afoot, something terrible was taking place, that indeed a flu, an influenza pandemic was taking place. Whereas the countries, the belligerent nations in the First World War, Spain was not a participant in the First World War, imposed some type of press suppression in order not to demoralize the troops. Now, what do we know? What lessons can we learn from that particular pandemic when thinking about the current crisis? In a wonderful work done by Robert Barrow, Jose Ursua, and Joanna Weng, they compute the impact on GDP and consumption of the Spanish flu and of the war itself for a large cross-section of countries, a large collection of countries, participants and not participants in the war. And as you can see, the effect of the flu was substantial. GDP contracted by almost 6% and consumption by almost 8%. Notice that the effect of the war was more dramatic, but that in terms of magnitudes, we're talking about very similar numbers. There were many casualties of that war. Great artists like Gustav Klimt or Egon Schiele, the great sociology Max Weber, or the grandfather of our current president, Frederick Trump, and some people who contracted the condition but survived. One of the reasons why this crisis became so widely known is because the King of Spain, Alphonse XIII, contracted the condition and survived. So did Walt Disney, so did the great Czech writer Franz Kafka, and the great economist Friedrich Hayek. We can learn more than that. There's substantial research going on. And one of the lessons that I want to convey to all of you today is that you can learn a lot by keeping track of the research that is taking place in order to learn about the current crisis by doing and revisiting the historical evidence that we have on the Spanish flu. One of the best things that we can read these days is a wonderful paper by Sergio Correa, Stephen Luke, and Emil Werner, which actually looks at how public health measures interacted with the recovery and future growth of those cities in the United States that adopted what they call non-pharmaceutical interventions, essentially quarantines and sheltering and social distancing. And their message is quite clear. Effectively, what you can see is that those cities that adopted a very strong quarantine and social distancing and sheltering measures, which are the cities in green dots, experience lower mortality rates, and most importantly, there's no evidence whatsoever that they had lower growth rates than those cities that adopted weaker social distancing measures, sheltering measures, or quarantine measures. This is a very important lesson. It basically means that the trade-off that we are discussing in the public domain these days between social distance and the impact that's going to have on the economy is a false trade-off. It looks like, judging by the evidence that we can gauge from this paper in a cross-section of American cities, that those cities that actually took stronger sheltering, social distance, and quarantine measures did better from a public health point of view, and they didn't suffer any long-run growth consequences as a result of that. If at all, the evidence seems to be pointing out that they did better than that. And, I think given that I'm the faculty director of the Helbrun Center of Graham and Dodd Investing, let me just point out that Omaha, the city of Warren Buffett, did relatively well in terms of mortality, aggressive measures of social distancing, and experienced very strong growth after the crisis. The Spanish flu was over. So what can we learn from financial markets? Are financial markets telling us something about future economic activity? We already have very good research, some of which is done here at Columbia Business School, telling us about what we should expect in terms of economic activity. So, for instance, what is the impact of the coronavirus crisis on dividend and GDP growth? In a recent paper by these two scholars at the University of Chicago, they used dividend futures to estimate the expected dividend growth in both the US and the European Union, the drop in that dividend growth as a result of the coronavirus crisis. And they estimate that by March 18th, those expectations had dropped by 28% in the case of the United States and about 25% for the case of the European Union. Expected GDP growth drops for the next year, quite similar for both places, from the US, for 2.6% for the US and for the European Union. They use dividend futures, which are essentially contracts that give you the right to the dividends paid by the S&P 500 at a given date. By looking at the drop in the prices of those dividend futures, we can infer essentially what the market is expecting in terms of dividend growth drops at a particular maturity. The second thing is that we also have evidence about how the market interpreted the stabilization package passed by the US Congress. In another paper by Gandhi and Veronesi from the University of Chicago as well, they actually look at credit spreads and notice that before the passage, those credit spreads were signaling a probability of a deep recession of 100%. Once the package was passed, that probability dropped to about 75, 73%. Finally, Does the market know something that we do not know? My colleague, Harry Mamaysky, in a wonderful paper, actually shows that financial markets do not covary contemporaneously with the incidence of coronavirus cases, but do forecast future coronavirus cases. So the market is hypersensitive, but seems to be processing the information more or less the way you would expect it. So a lot to be learned from financial markets. The financial markets are markets for information. They're telling us what is that the state of the economy is, as well as what the future may bring. That doesn't mean, as we will argue shortly, that there are no opportunities to build resilient portfolios with a large margin of safety, the operational principle when it comes to risk management, if you are a value investor. So let's talk then a little bit about how to think about investing in times of crisis. I was talking with my students yesterday, and I was telling them that, I arrived to the profession. I became an assistant professor at the University of Chicago in 1996, 1997, and that my first experience was the Asian crisis. The year after, we had the Russia default and the LTCM crisis. Then, of course, we had the tech bubble bursting and the bear market between 2000 and 2002. A few years later, we had the global financial crisis. In 2011, 2012, the Eurozone crisis got going in earnest. And finally, in the last few months, of course, the coronavirus crisis. This plot reports the VIX as computed by the Chicago Board of Options Exchange. The data is monthly and starts in January of 1990, and it goes until March of this year. And of course, crises coincide with periods of a big increase in the volatility index, what some people in the press refer to as the fear index. Notice how severe this crisis is second only to the spike on the VIX during the global financial crisis. In fact, the fact that we are reporting the data on a monthly basis masks the fact that we had the maximum realization of the VIX during the month of March on a daily data basis. So this is a tragic crisis, a phenomenal event, not only from a public health perspective, but also from a financial markets perspective as well. Now, all crises have the same flavor to it. What you experience is a phenomenal increase in uncertainty that essentially results in a fattening, to put it that way, of the left-hand side tail of the distribution of outcomes. And the way I want you to think about those outcomes are things like unemployment rates, GDP growth being strongly negative, or perhaps fatality sadly associated with this terrible crisis. As a result of this fattening of the left-hand side tail of the distribution of outcomes, markets drop dramatically, essentially because they cannot put a floor on asset value. So think about what was happening in September of 2008 or during the Eurozone crisis of 2011 and 2012. It looked like there was no floor whatsoever in the market. The uncertainty is so deep and so profound, and the policy confusion so big that it looked like prices are always going down all the way to zero. Now, in order for markets to stabilize, typically when you study this financial crisis, two things need to happen. First, the market needs to learn how bad things can get to assign a floor to valuations. So the market wants to bound the possible range of outcomes in order to basically pin down how bad things can get. The second is that the market wants to see a policy path and a commitment by part of policymakers to remedy the economic fallout. Now, you can ask yourself then, are we on our way for both things to happen? Is this what we have seen over the last few days, giving you a sense of whether these two preconditions for this crisis to stabilize already in place? Now, all these things are, good and fine, but we want to build a robust and resilient portfolio. Let's just remind ourselves of some basic rules that we need to follow when building such a portfolio. First, think about the valuation in a robust way. What do I mean by this? think about fundamental value on a sustainable basis and the conservative assumptions. And I'll give you later an example of this. Ignore timing. Ignore questions like, is it a good time to buy now? The only question you have to ask yourself is whether you have enough of a margin of safety. The price may be low enough already to give you that margin of safety. You're confident on your valuation, that's the moment to act. And if the price goes down further and nothing questions your initial judgment on that particular name, go ahead and buy more. And in particular, as I will argue shortly, you can actually ask yourself whether the drop in valuations is justified by the worst case scenario, say in future earnings growth. We're going to see a simple example of how to do that shortly. The second thing to take into account is risk management. This, tragic as it is, sad as it is, deep as our distress is a temporary shock. It's not a permanent one. But you have to ask whether that company of interest, when thinking about adding that company to your portfolio, can survive this temporary shock. Does it have perhaps excessive financial leverage? Does it have a lot of operational leverage? Does it have a big list portfolio that they need to finance? Can it survive this temporary shock? If you think there's going to be some permanent ramifications of this crisis, think about the resilience of your portfolio to perhaps long-term policy reactions or perhaps some structural changes to which we shall return. Third, don't be afraid of concentration. A good investment process should lead to higher, not lower concentration. And the reason is very simple. Some companies, some wonderful companies out there, are going to offer larger margins of safety. Naturally, then your portfolio will increase its weight on those companies that are giving you larger margins of safety. And fourth, and perhaps more subtly, think about the market. Buy the product or service, not the specific company. I know this sounds a little bit mysterious, so let me give you an example. I don't know what is going to happen with airline companies. They may go bankrupt, they may need some type of government assistance, your equity stake might be diluted. But what I know is that people will go back to flying in the future, perhaps not immediately, perhaps not this year, but certainly in 2 or 3 years. Well, you want to bet on that. You want to take a position on that without buying a specific airline company that may suffer a reorganization on account of the severity of this temporary shock that we're going through. So you may want to look at that company that is producing a specific airplane part and so on and so forth. Okay. Very good. So let's discuss 2 examples. These are 2 examples for the benefit of full disclosure. These are 2 companies I own. So my money where my mouth is, and that I have discussed with the students over the last few weeks, trying to understand what the market is telling us about these companies. The 2 companies are Nike and Deere, 2 well-known companies. I chose these companies just so that everybody is familiar with what they do, and we don't need to spend any time introducing these 2 corporate behemoths. So on February 12, 2020, we studied the case of Nike with a wonderful group of students that I have in the MBA program, my Modern Value students. We studied this company. We like the strategic position that it occupies in the athletic apparel and footwear market. It's essentially a duopoly with the European company Adidas. It had a rich market valuation for growth. We liked what we saw. The expected rate of return on this company, we thought it was about 10%. It was a good compounded, but not cheap by traditional measures. Last week, though, the market gave us Nike for $65, when a couple of weeks ago it was giving us this company for $100. So the question is it a good buy? What is the market telling us about this company? So there you have the dramatic drop in the stock price that this company experienced starting in the 2nd week of March. Now, how are we to think about this? So for the purposes of this simple presentation, what I'm going to do is simply illustrate how you can approach valuation in a very robust way by giving yourself several scenarios that you can contemplate in what concerns the future profitability of Nike. Now, you can play any way you see fit and incorporate your more extreme assumptions in a simple analysis like the one I'm going to be proposing here to you in the next 5 minutes. So in particular, I'm going to look at 3 of these 4 cases very briefly. Now, it can be a little bit tricky and the numbers are a little bit hairy, so I will just touch lightly on these things, not to bore ourselves too much. The first case is one that says, well, this company was growing free cash flow, say, at a number between 5 and 6%, as I'll show you shortly, revenues and profitability. Let's assume that the shock, the coronavirus shock, is such that future profitability growth goes down permanently. That's case A. Case B is the one where this company experiences a drop in profitability growth for a year, but then it goes back to the long run rate of growth on profitability. Notice, though, that you never make it back. You never make it back to where this company would have been in terms of free cash flows had the coronavirus crisis not happened. This is case C. In case C, this company suffers a severe shock. They are not selling as many sneakers and apparel as otherwise they would have, but in 2 years, they go back to where they would have been. And finally, in case D, you can model these dynamics any way you want. Now, I'm taking 1 year just as an example. You can actually do this analysis with 1, 2, or 3 years and model it any way you want, but just simply to illustrate some of the basic ideas. Now, you may be wondering how I'm going to learn what the market is inferring regarding the future profitability of this company. Well, we're going to use a very simple tool that many of our students learn in the corporate finance classes, essentially the present value of future free cash flows as a measure of the enterprise value of this company. It's just basically adding up the free cash flows that we are expecting from this company, appropriately discounted by the weighted average cost of capital, R. And what I'm going to do is simply make some extreme assumptions to make this as simple as possible. I'm going to assume the weighted average cost of capital of this company is constant, and the long run growth rate of earnings, G, is also constant. If that's the case, you can show that the enterprise value of Nike is simply tomorrow's future free cash flow divided by the difference between the weighted average cost of capital and the rate of growth of earnings. And then I'm going to ask myself a very simple question. Well, I know more or less what G is. I know more or less what the free cash flow is going to be this quarter. What is the valuation telling me about the discount rate, the weighted average cost of capital, little r? I'm going to use the valuation as of February in order to assign a discount rate for this company. And then I'm going to basically solve that simple equation 1 for the rate of growth of earnings under case A, B, and C. And that will tell me what the market is thinking about the future profitability of Nike, given the drop in the enterprise value or the market cap of this company. So after doing a little bit of magic then, we can solve for that discount rate. And I'm going to do it by using the valuation in February 12, which is when I did the valuation of Nike with my students in the modern value class. I'm going to take the rate of growth of profitability to be a number between 5 and 6%. And where do I get that number from? Well, I just simply plot the average over 5 years between 1999 and 2019 of both revenue and operating income growth. And as you can tell, in the last 20 years or so, Nike has had average earnings growth below 5% only in a couple of years. So we're being quite conservative here. So there you have it. When you actually do this simple analysis, I want you to focus in line 14 of that table. What the market was telling you in February 12, 2020, is that the weighted average cost of capital of Nike was a number like 9.4%. The number that we used in my class with my students was 7%, so a little bit more aggressive, but perhaps the market was already discounting the comings and goings of the coronavirus crisis in China as well as in other countries. I'm going to use that discount rate to do this scenario analysis. In particular, I'm going to ask myself next, What happens if, for instance, I assume the coronavirus crisis affects permanently the rate of growth of earnings of this company? That's case A. Notice that it was growing at, say, 6%. Well, what is the drop in the rate of growth of earnings if it's a permanent shock to that rate of growth of earnings? So we can use the valuation of Nike in March 24, 2020, when we did this case with the students last week. And after doing the analysis, you find that the permanent drop in the rate of growth of free cash flows, in order to justify the valuations that we saw in March 24, 2020, is of about 50 basis points. We go from essentially 6% to 5.5%. It doesn't look that extreme, but remember, this is a permanent drop. It goes on forever. So these things compound to quite a large number eventually. What if instead we go to case B? You have a temporary shock, and then it goes back to the long run growth of free cash flows, but it never makes it back to where it would have been had the coronavirus crisis not happened. Well, in that case, the drop in the rate of growth of earnings in the next year, and again, you can do this for 2, 3 years, whatever your horizon is about 9%. So that basically means that the value drop that Nike experienced between February 12th and a month later in March of 2020 can only be justified through the lens of this model with a discount rate of 9.5% if profitability is going to go down next year by about 9%. We're going to go back to this number shortly. Finally, we can ask ourselves, what happens if instead, there's a sharp contraction followed by steep recovery in 2 years? So notice that in case C, yes, you don't sell these fancy sneakers or these t-shirts, but then essentially a year from now, people get out of their houses and go back and replace those old sneakers. They buy some equipment and so on and so forth. And basically you make up for the loss by going back to where you would have been had the crisis not occurred. Okay. So in that case, there you have a little bit the way I want you to think about this. We're in March of 2020, today is April 2nd, March 2021, we're going to be at the trough. The rate of growth of free cash flow of profitability, say, is going to be very, very steep, a very steep drop. But then starting in March of next year, we're going to see a very strong rebound for this company. Well, in that case, you actually compute very easily that the drop has to be enormous. And why is that? Why has the drop in the rate of growth of earnings in the next year has to be so enormous in this particular case? This is why discounted cash flow models are so misleading when it comes to the valuation. And it's simply because the discounted value of free cash flows for the next year is a puny, tiny fraction of the enterprise value of this company. It's about 3 to 4% of the enterprise value of this company. So if you have to justify the drop in the market value of Nike on account of what is going to happen to this free cash flow in a year or so, you're going to have to assume a massive movement in profitability for Nike for the next year. That's why you always have to focus on the long term. This massive movement of Nike is very difficult to rationalize, appealing to the potential losses they may suffer, not only in the next year, but in the next 2 years. Why? Because those profits account for a relatively tiny percentage of the enterprise value of this company. Now, I selected this company because it filed last week its 2020 Q3 quarterly report. So we already have a bit of a clue as to what is going on with this company in terms of profitability and revenue. And it is indeed the case that a significant percentage of the sales of this company is coming from what they refer to in the annual report as Greater China, essentially what they sell in China during the months of December, January, and February of this year. And what you can see is that, of course, there's been a drop in revenues, but not as severe as you otherwise would have assumed. Indeed, here you have the fiscal year 2020 Q3 sales, both in North America, compared to the fiscal year 2019 Q3 sales. In the last column, I give you the change in percentage terms. Notice that in the United States, so far, no effect as of fiscal year 2020 Q3, no effect on the sales in the North American continent. In Greater China, you see drops of 4% in footwear. And remember, this includes the month of January and December, which were the months of the acute phase of the coronavirus crisis in Wuhan. Then you have a 10% drop in apparel and a small increase in equipment, but notice that that's a very small percentage of the overall sales in China for Nike. So that's why the market reacted so strongly to this quarterly report. And there you have indeed the price of Nike following the filing of the Q3 quarterly report. The market reacted very strongly because it realized that whatever they were imputing about the future rate of growth of earnings for this company didn't seem to be borne out by the data, in particular data that already has the effect of coronavirus on the sales in China. But as I just said, we actually propose using a different valuation approach, one that computes how much should you be willing to pay for a company on a sustainable basis, abstracting entirely from growth. I've selected one company, a great American company, Deere, the farm equipment company. This is a company that was trading at about $180 a share before the crisis. It dropped dramatically all the way down to $110 a share throughout the last few weeks. It bounced up to 140, where it's been lingering for the last couple of days or so. So instead of actually doing silly DCF calculations, let's do a sustainable calculation for the value of this company. Before that, for those of you who are familiar with the financials of Deere, this is one interesting company because it's essentially two companies in one. There's a company that you know, the equipment operations company, the one that produces those wonderful tractors and construction equipment. And then attached to it, there's a special purpose vehicle that essentially buys the receivables from the equipment operations and securitizes them, selling tranches of those receivables to capital markets. Now, you want to analyze this company then by splitting it in two. You want to value the business operations and then basically see how much money Deere is making out of running this special purpose vehicle that is there to finance the purchase of its own equipment by part of the farmers. So we're going to value on a sustainable basis the equipment operations and then put as an add-on at the end of the calculation profits coming from this special purpose vehicle that we call John Deere Financial Services. So here it is. I know this is too much to take on during your lunch break, but let's just make a bit of an effort on trying to understand what we're doing in this table. For the purpose of this conversation, let's just focus on the column that is marked fiscal year 2019. What I'm doing there is essentially calculating the sustainable net operating profits after taxes of this company, the adjusted NOPAT. That's line 11 in the table that you have in front of you. What I did to calculate that NOPAT, that adjusted NOPAT, is take the operating income of this company, about $3.8 billion last year, and then made adjustments that remove the effect of growth on the income statement. Deere is a company that invests some of its capital in improving its product portfolio. We have to put that back in order to calculate how much would this company be able to generate in terms of profitability if it didn't grow. We're abstracting from growth. We're doing everything on a sustainable basis. We apply the taxes, and that gives us about $3.3 billion of adjusted NOPAT. You add the profits from John Deere Financial Services, which is a whooping $942 million, and that gives you a total adjusted net operating profit after taxes, line 13, of about $4.3 billion. I use a discount rate of 7%. That gives you an earnings per value of the business operation of this firm of around $62 billion US dollars. Plus the cash, minus the debt, it tells you that the earnings per value of the equity, how much should you be willing to pay for this company on a sustainable basis, even if this company were to experience no growth whatsoever, is about 58 billion US dollars. The market cap of this company as of today was about $43 billion. Now, notice that what we're doing here is simply calculating how much should you be willing to pay for this company on a sustainable basis. We are redoing the income statement to put that component of growth capex that is expensed, which in this case is mostly the research and development. And then we're assuming this company can generate on average about 10 to 11% in operating margins for the foreseeable future. But again, no growth. And you should be willing to pay for such a company about $58 billion in market for the equity. Is being sold to you by Mr. Market for about $43 billion. So in order to conclude and to open the floor to questions, let's just remind ourselves then of what you want to do when building your portfolio. First, think on a sustainable basis. Think in a robust way. Give yourselves very conservative assumptions. Do scenario analysis, either to infer what the market is doing, as we did in the case of Nike, or to actually give yourself conservative assumptions to estimate your sustainable valuation by perhaps putting a markdown on those operating margins in the long run. Ignore the timing. That's just too difficult to do. If that company is trading at a sufficiently deep margin of safety, at a sufficient discount, go and buy it. If you're confident about your valuation and Mr. Market is throwing you that company for a 40, 50% discount, why wait to see whether it's going to give it to you for a 60% discount? If it does, buy more. Second, and critically in any crisis, do risk management. This is a temporary crisis, but you want to make sure this company doesn't have any form of operational or financial leverage that can compromise your investment in this company. Distinguish between the quality of the business operation and the quality of the balance sheet. These are two different things. You may like the business and you may not like the balance sheet, simply because there's excessive leverage. This is particularly relevant today because, as you know, many investment-grade companies have levered up substantially over the last few years. And last but not least, think well, which is not just a recommendation for this crisis, but always. Buy the product or service, not the company. Think about the market itself. Think about the airline market. Think about the automobile market. Think about the tourism industry, and so on and so forth. The particular company may be compromised, again, because it may have the wrong balance sheet, because it may not have the strength to withstand the severity of this temporary shock. So think about the long run. Place yourself thinking through the product or service that company itself is selling, more than about the company itself. If you do all these things, at least from a financial point of view, you will do well. And now let's open the floor to questions. Meredith, I'm at your disposal.
Great, thank you, Tano. So the first question is in from R.A. Faroknia. He asks, from a supply and demand perspective, what are the primary differences of the current crisis with those in 2008 and 2000, where irrationality and asset price overvaluation seem to be the major culprit?
So this is an excellent question. So there are important differences in between the global financial crisis and the crisis today. One of the important differences is that during the global financial crisis, there's one sector, which is the nervous system of any market-based economy, which is the financial system, that had severe solvency problems. We don't know how big the hole was in September of 2008, and we don't know where the hole is located, the solvency gap. But we know conceptually what the problem is. So then you have to actually put a process in place that will allow you to discover the extent of the solvency gaps as well as the location of the solvency gap. This is the reason that why once the Federal Reserve came with that program that was popularly known as the stress tests, I think it was formerly known as the Supplementary Capital Assistance Program, now the market saw that we had a process in place that in addition was fully funded to both discover the solvency problems of the financial system and locate them in the particular financial institutions that had been exposed to the real estate cycle. That's why the market turned when it did. This crisis is very different. It's more severe because in this case, the policy intervention cannot be targeted the way it was then. I don't want to minimize the challenges that we faced during the global financial crisis, but what was easy then was the diagnosis of the problem. There may have been severe political economy problems associated with recapitalizing the financial system. Where was the money going to come from? Was the taxpayer willing to address the solvency gaps in the financial institutions? So those political economies problems needed to be addressed, but once they were addressed, both in the US and in the Eurozone, the crisis in financial markets was over. This is not the case here. The interventions are less clear. We don't have the wealth of tools or the precision that we had with the tools at our disposal in the global financial crisis, to be more precise. Not only that, the recovery is likely to be very uneven. Some sectors can recover quite fast, any service that can be provided remotely, whereas other things like tourism, they're going to take a long time to come back. And thus, the economy is going to need support for those sectors for an extended period of time. Finally, in a way, what we're seeing now is an earthquake in slow motion, whereas the global financial crisis was an earthquake. So it lasts for a few minutes. It's terrible. Everything has crumbled, but at least we know how we have to rebuild. In this one, we're still trying to understand the severity of the crisis we're experiencing, and we're trying to understand the type of interventions that we need to do. So it's going to take longer to play out. And going back to that recommendation about how to build your portfolios, you will need a lot of stamina to withstand the volatility that we're likely to experience in the next few weeks. For instance, once you put a certain amount of capital in the banks in 2009 or in 2011, 2012 in Europe, that's it. If you put enough capital, you can rest assured the crisis was over. Can we be sure that even if this current phase of the coronavirus crisis we're successful in flattening the curve, the virus won't come back once we all go back to work? We don't know. There are things you can do. You can check what is going on in China when they lift the quarantine measures they had put in place in a week or so. We can look at what is going on in Hong Kong and so on and so forth in order to understand whether we can safely go back to our lives. Importantly, also monitor to what extent the healthcare systems will have enough capacity to support the reactivation of the economy. My intuition is that the people won't go back to work unless they have some assurance that should they get sick in a second wave, they will have the healthcare in place to help them through their conditions.
Great, thanks, Tano. The next question following up on that, in terms of rebuilding your portfolio, what factors would tempt you to sell certain companies right now in the current portfolio without being irrational and committing that capital to either a Nike or a Deere?
So you want to turn over your portfolio. There are probably there in your portfolio, if you had a robust portfolio, things that, they were not, they may have gone down in value. You may still have a margin of safety of say 10, 20%. You've experienced some gains because you bought them at an even deeper discount. and you have opportunities out there with deeper margins of safety, with deeper discounts, by all means, go and turn over your portfolio, because as I argued in the presentation, you should not be afraid of having some extent of portfolio concentration. Your valuation approach and the confidence in your method should lead you to a more concentrated portfolio in these particular circumstances. Now, one thing that I'm going to recommend as well is, as I used to tell my students during the global financial crisis, there's no need to get cute, meaning there's no need to find that hidden gem in some corner of the market. There are wonderful companies out there with wonderful business operations trading at very attractive valuations. You don't need to search very deeply in the market to find good companies that you want to hold and they're going to compound. One way you can think about this particular crisis from a portfolio point of view is the following. All of us have those companies we wish we had in our portfolio because they have wonderful business operations. They are protected by barriers to entry. They're relatively well run. They have large addressable markets. They have good governance structures, perhaps because they're family owned, or they are have a large shareholder that is providing the monitoring services that you want in your company. And all of a sudden, the market is telling you the growth of those companies for free. They don't look particularly cheap, but I want you to think about the valuation for these companies on whether the market is asking you a very big price to buy those growth options. Remember Charlie Munger's line is that you may willing to be paid, you know, a fair or even a bit lower than fair price for a wonderful business operation that can compound your money for you for many years to come. That's what I meant by you don't need to get too cute. You don't need to find that wonderful company that is trading in some forgotten corner of the market. Crises such as this one or the global financial crisis are opportunities to buy those wonderful companies you always wanted to have in your portfolio, but they were never cheap enough to buy.
Great, thank you. Next question is from a value investing program alum. What are the best practices in incorporating the odds of bailouts for particular sectors into valuation models? Clearly, there are some businesses in today's market that are zeros without bailout, but the market seems to be giving favorable valuations due to limited information about the criteria for bailouts.
So that's a fantastic question. You know, if I sound tentative, it's because I'm thinking about that question in the context of this crisis, because going back to the very first question that was asked on the comparison between the global financial crisis and this one, is one in which the lessons don't transfer as cleanly as they did, as they do for other lessons. So let me give you an example of this. So during the global financial crisis, what it was phenomenal fun was to actually look at, say, subordinated debentures of some banks in the Eurozone. And it was relatively, I wouldn't say easy to see that eventually the public sector was going to provide some form of support to those financial institutions because they wanted to avoid imposing losses on those debentures in order to avoid a run elsewhere in banking stocks. So you could actually go and find some of these liabilities that were trading at very deep discounts in the assurance that essentially governments, in particular in the Eurozone and the Eurozone overall, was not going to allow haircuts on some of those debentures precisely because of the fear that that may elicit a bank run, certainly in the wholesale market and potentially in deposits as well. So you could actually go in, buy those debentures at very deep discounts, and you know, profit from the type of support that you knew eventually the governments would eventually provide. Now, my fear with, you know, so that was a very clear I don't know how to say it. It was very clear trade. And the problem there is that, sometimes you have to work a little bit hard to locate interesting subordinated bank debt in Ireland or in Spain and some other countries. But once you found it, there were relatively easy trades, and there were essentially bets on the bailout, and you could actually trade on that. Now, in this case, it's a little bit trickier, and in my opinion, is because of two things. First, as I mentioned before, what it was unique about the global financial crisis is that you knew where you needed to intervene. You needed to intervene in the financial system. You needed to intervene in the banking sector in the US, in the insurance markets, in the banking sector in the Eurozone, and so on and so forth. So once you intervene there, it was very targeted. It was painful politically. That's why it took some time to work it out. But we knew where we were going to end. We knew from the very beginning that eventually, if the private sector was not willing to supply the capital to recap the financial system, the taxpayer would have to come in. Whether you liked it or not, that's where we were heading. Now, the taxpayer could protect itself with, getting preferred and things like that, but eventually capital had to come from somewhere. Here is much trickier. Are we going to recapitalize the tourism industry? Are we going to recapitalize the hotels? Are we going to recapitalize the airline industry? What is the size of the bailout? So I think it's much less likely to happen precisely because of the lack of clarity on the type of sectors that are going to need support. I think what we're going to get is a combination of grants for small and medium-sized enterprise, essentially uncollateralized loans from which these SMEs can walk away, as well as loans and liquidity support for the large corporates, which is what is incorporated in the bill. My sense as and second, by the way, another important point is the appetite for additional bailouts. I think there's a limited amount of capital that you have with the taxpayer and for the public when it comes to this. And the public is going to rightly demand support that is direct to those those in our societies that are less privileged. And we're going to offer more targeted interventions to relieve the distress of the less well-off amongst us, as it should be the case. So my sense is that this is not a crisis in which you want to actually trade in the expectation of any bailout. They may happen, but I think it's going to be very tricky and very messy in a way that it was not during the global financial crisis.
Thank you. We've gotten several questions about timing. Here's one. Could you comment further on timing? While you have explained we will face much volatility in the weeks to come, at what point do you think we will see the market overall stabilize? And what factors should we be looking for to indicate that we are approaching this point of stabilization?
Well, I think so again, I'm terrible at market timing. Let me just emphasize this, that you should not be thinking about timing. You should be thinking about doing your bottom-up valuation, and if you like this company because it's trading at a sufficiently deep discount, go ahead and buy it. So I very much encourage you all to really not think so much about the timing. I want to go back, though, to some of the comments that I did early on in the presentation regarding this matter of timing. As I said, essentially, the market, as we all know, hates uncertainty. And what I mean by this is that sometimes the market doesn't even know what their support is for the valuations, just simply because we're experiencing such a peculiar event that none of us have experienced in our lifetime, that we just don't know what the right way of approaching valuation is in a situation like the one that we're going through. Again, I encourage you, by the way, to read business and economic history, and the wonderful research produced by many scholars on the Spanish flu, okay? But what is important is that the market wants to see effectively two things. It wants to see some bounds on the extent of the losses, because the way the market works in many occasions is, well, now I know what the floor is. At least I know that I should be willing to pay this much for this particular company, for this particular, even the index, and we can build from this, and I'm going to be increasing my exposure to this particular name as conditions improve. And the second thing they want to see is a path for the resolution of this crisis. This, I would argue, we still do not have. And what I mean by this is two things. First, policy response, which is good so far with the stabilization bill of 2 trillion that was passed last week, is clearly not going to be enough. So new packages are going to be needed. So much depends on whether these packages are going to be well designed or not, and the politics of these kind of bailout packages, if we want to call them that way, which are going to be very targeted to households, which, remember, are the ones that are voting in November. Second is the actual public health crisis. I mean, we still have no clarity whatsoever about when is that we're going back. I mean, when is the peak going to be reached? Governor Cuomo in New York told us yesterday that now they're expecting the peak to be reached at the end of April. So he told us very bluntly that we have another month of this, another month of sheltering and social distancing. So that delays the recovery by that much. And in the next few weeks, we're going to learn to what extent we can go back to our business by looking at what is happening in Wuhan when they lift all these quarantine restrictions. But again, I think the market has stabilized to some extent. I'm very bad at doing predictions about what is going to happen in the future. This is not how I construct my portfolios, and I teach my students how to construct those portfolios. Look at the valuations and be ready for some gut-wrenching volatility. And by the way, you should love the volatility. The volatility is going to give you additional opportunities to buy these great companies at deep discounts. So, obviously, none of us want to see this getting worse. This is the last thing that we want to see. It's a tragic situation, and our hearts go to all of them, everyone who's experiencing this terrible condition. But as an investor, volatility is always good.
Great, thank you. Following up on that, for foreign companies, how should we incorporate into our valuation the different country risks? For example, the larger impact on the Spanish economy due to its reliance on the tourism industry.
Yes, this is very important. There, what you want to see is, obviously, you want to be sensitive to these sectoral issues. I'm going to talk at length with my students in a couple of weeks about the hotel industry, precisely to analyze this deeply. But right now, in countries such as Italy and Spain, what you want to do is focus on that segment of the stock market where you have these large global companies. You have plenty of those in both markets, and you want to give yourself at least the protection of knowing that the local businesses may suffer because the recession in Spain is going to be brutal because of its dependence on tourism. Spain receives anywhere between 70 and 80 million tourists every year. It's very clear this is not going to happen, and that the tourism season, which is so important and the lifeblood of the Spanish economy, has become severely compromised. So obviously there are a lot of companies that are going to suffer as a result. Companies may experience severe distress. Again, issues of risk management are front and center, because one of the things that has changed since the global financial crisis for a lot of the Eurozone companies is that they've leveraged up substantially on account of the ECB corporate bond purchase programs that have been put in place in order to help with the Eurozone crisis. So you want to really, really look at the balance sheet of some of these companies, particularly, and be careful in how you treat those balance sheets. So if you look at infrastructure companies, make sure to really clean those balance sheets. Does this particular debt have recourse against the balance sheet of the holding company is absolutely essential. So looking at things about like the organizational form of the company you're buying is going to be critical. But there are some great companies that you can buy. My favorite example that we discussed with the students last week was Ebro, which is the second largest. Ebro is a Spanish company, is in the business of distributing rice and pasta. I'm sure all your kitchen kitchens are full of rice and pasta. Well, the company has done relatively well. It's the second largest distributor of pasta in the United States. I think it's the largest or the second largest distributor of rice. These are companies that have, not particular moats because, there's nothing, there are no barriers to entry when it comes to rice and pasta, but they have phenomenal distribution networks and they're going to do relatively well. And they have large business operations outside of Spain. So should they do poorly in Spain, you can rest assured they will do well overall on account of the exposure they can have in other countries. The other one that my students hear me talk about is companies like Viscofan. This is the sausage wrapping company. They're in the business of wrapping hot dogs, all sorts of chorizos and so on and so forth. It has about 1/3 of the global market. A significant fraction of its income statement is linked to the world economy and has nothing to do with Spain. So buying those companies that have resilience on account of the global footprint is a good thing to do at this stage of the crisis. But don't be shy. There will be some opportunities also for those companies that have perhaps more exposure to the local economy than the one you would like.
Great, thank you. Shifting gears a little bit, given that private equity and distressed investors often make great returns in times of market stress, why do we see such dramatic drops in the equity values of the publicly traded mega funds?
So I've thought a little bit about this, and I don't have anything very deep to say. My intuition about this is that in the previous cycle, in the previous financial crisis, they did very well by providing liquidity to some very distressed companies, financial companies, and so on and so forth. This doesn't seem to be the case in this particular crisis, even though there are some companies that are levered. The amount of cash in the corporate sector is quite large. So you are not going to have you're not going to capture this time the liquidity premium to the extent that you did in the previous crisis. That's my intuition, but I've thought a little bit about this and I still don't have my finger on that question.
Okay, great, thank you. How do you see the semiconductor industry in the near future, 3 years, given the virus affecting consumer products production sales and a possible China-US split?
So this is a broader question. The semiconductor industry is a highly cyclical industry, so it's bound to suffer as a result of this. It's always been. Now, if we are going to learn about, we're going to learn one thing in this crisis, which is, let me take a step back. This crisis is accelerating pre-existing trends, both business-wise, in the economy at large, policy-wise, and even I would argue international trade-wise. It's going to accelerate many of the pre-existing trends. I don't think this crisis is a break relative to the things that we have seen before. So if you allow me for a minute to be a little bit broader, I would say if we think that globalization was in reverse, both on account of structural changes in the economy, but also policy decisions, well, I think we would all agree that this crisis is not going to help. It's probably going to accelerate that reversal of the globalization trend that we had experienced since the early 80s all the way to the global financial crisis, say. Okay, so I think it reinforces whatever you were thinking about those trends before. The way I would want you to think about this crisis is going to increase, it's going to accentuate those trends, and one of which is precisely the cloud business. One of the things that is, just imagine for a moment what this crisis would be in the absence of all the cloud services that we can get, from e-retailing to leisure in our accounts of Netflix or Amazon Prime or whatever service provider you're using, information that we can get directly from our public health officials, the Zoom technology that we're using to teach our students in the middle of this crisis. So, my sense is that this is going to reinforce the movement towards the provision of services in the cloud, which of course will be a bonanza for the semiconductor industry. And there you want to understand who is going to benefit more from that. as I've argued with my students before, the problem in the semiconductor industry is that the size of the pie is enormous, because we all know the cloud industry has a long ways to go. Now, the question is, because the size of the pie is enormous, a significant amount of capital is going to be deployed in that industry in order to contest that pie. That's why, for instance, if you look at the valuation of some of the traditional semiconductor producers, well, you know, they are not as attractive as you otherwise would assume given the growth of the cloud. And it's simply because the market is anticipating that a lot of capital is going to be deployed in order to actually contest. So in that segment, you really want to look at some of the companies that have very specific technologies without which the cloud cannot operate, and for which you know, there's no clear substitute at the moment or in the future, either because the technology is proprietary, or because, most importantly, the value added in the value chain in the cloud industry is small enough that it's not worth deploying capital to contest and compete with those smaller companies.
Great, thank you. How does the potential weakening of the US dollar impact the valuation of companies?
So the valuation of the dollar is going to be a key feature of financial markets in the near future. And I like this question very much, because the valuation of the dollar vis-a-vis the Swiss franc, the euro, the Japanese yen, and so on and so forth, is going to be the canary in the coal mine whenever we're going to see some distress in world financial markets. Now, it's a pity, because I had some slides on the dollar that I decided to skip to actually make some comments on that, so I won't be able to use them to illustrate what I mean. It's always the same thing. If you look at this crisis, there's a period where the dollar drops, and then there's a moment where the dollar appreciates, when we realize it's not just the US, but the world that is in crisis. And then you have the standard flight to safety type of dynamics, by which investors all around the world want safety, and they want safety in dollars. So they don't just want safety, they want safety denominated in this currency, which is the US dollar. It's going to be quite difficult to actually, assess this, because once again, the volatility of the exchange rate is enormous. Now, the general lesson that you want to is that you want to buy stocks abroad whenever you see a spike in the valuation of the dollar, because you can rest assured that one way the US solves its external imbalance problem is by lowering the returns to investors that hold dollar-denominated assets through the depreciation of the currency. If you hold, say, euro-denominated stocks or Japanese yen-denominated stocks, you can rest assured that the relative strengthening of the euro or the yen will enhance your returns as a result. So by all means, keep an eye on the valuation of the dollar, and you really want to basically think about timing your purchase of that attractive euro stock precisely when there's a spike in the valuation of the dollar on account of some global event that is making investors seek the safety of, say, US treasuries, because you know that eventually the dollar will return to its long-run valuation, as a result, increasing the returns denominated in a foreign currency.
Great. Thank you. And a question, just clarifying your previous slides when you were doing the presentation part, could you please clarify once more how the financial services arm of a manufacturing company can be used as a put option to the core arm, and how that plays out in an earnings power value scenario?
It's very important. Thank you very much for this question. I realized that I didn't clarify this, and perhaps that's a bit misleading. What I meant by that particular slide is that effectively, when you read the annual report of Deere, the equipment operations essentially writes a put option to the financial arm, by which what is meant is that if any of those receivables were to default, the investors who acquire essentially the securitized receivables can rest assured that the default on the receivable will not be transferred to the capital market, but rather the shareholders of Deere will absorb the loss in that receivable. So implicitly, the equipment operations has written a put option to the financial services. Now, how can you then protect yourself against the risk that Deere is extending credit to unworthy risks in order to generate revenue growth? Well, you have to look at the default rate of those receivables. And you have information about that, both in the annual report of Deere, as well as the annual report of John Deere Financial Services. And when you look at that, you see the default rate on those receivables is actually not that large. That Deere, a company with 140, 50-year history, an enormous franchise value, is not going to basically play the short game of increasing its revenues through the extension of risk of credit to unworthy risks in order to please some Wall Street analysts. They keep the risks low, they keep those defaults low, but you can actually check and look at those defaults on those receivables. This is not always the case, by the way, with equipment operation companies. So look at the default rates of other equipment operation companies, such as Harley-Davidson or the automakers and so on and so forth. Okay, so it depends on whether the company in question has powerful barriers to entry and a franchise to protect.
Thank you. What is your view of the fiscal policy difference between EU and the US in dealing with the pandemic? Will policy be more favorable for EU companies? Perhaps they will rebound faster than US companies.
Bush. So this is a difficult question. Look, the general rule that you have to follow when thinking about the differences between the US and the European Union is that the political economy of everything that we do in the European Union is 10 times more complicated than it is in the United States. Okay, why? Well, because we have this complex thing that we call the euro, common currency, that imposes limits on what we can do fiscally. So my hunch about what is going to happen in the European Union over the next few months is that as the extent of the economic damage in economies such as Spain and Italy becomes apparent, some form of assistance will be needed to stabilize the economies of this country. I don't think there's going to be I think people are calling them the coronavirus bonds issued against some non-existent European taxpayer, because as you know, the EU doesn't have significant taxing authority. We may see some nominal things, small things, but I think the main policy tool that is going to be used to stabilize these economies from the fiscal point of view is the European Stability Mechanism, and this for two reasons. First, because we have it. That was the whole point of creating it. It was to create a particular institution that can be funded and then lend to sovereigns in exchange for some form of conditionality. Here, because we would all agree that this is an act of God, so to speak, as insurance companies speak of these things, is something that is not related to the bad practices when it comes to government deficits of some country, but is really just a bad shock over which Spain had no control whatsoever. The conditionality is likely to be light. The conditionality associated with that loan from the European Stability Mechanism, Spain is likely to accept it. And the most important advantage associated with this is, one, that Spain will be able to fund itself at lower interest rates than the ones that they would be able to have were they to borrow directly from financial markets. And second, and most importantly, is that once you take a loan from the ESM with light conditionality, which is my prediction, the European Central Bank can buy your bonds and the sky is the limit there, so they can control the interest rate that that country is going to be paying as a result.
Great, thank you. So Tano, we've gone through all the questions just on time. If you have any parting words for the group.
So no, thank you so much all for joining. It's going to be important in the next few weeks to obviously be steely when it comes to your portfolio. Think simply, cleanly, don't overcomplicate matters, don't think about the timing, look at the valuation of those fundamental companies, do risk management, make sure those companies can absorb the severity of this tragic shock, and you will just fine. But most importantly, listen to your public health officials, listen to your mayors, to your governors, take all precautions, shelter, quarantine, and stay safe and healthy, which is the most important thing. Everything else will work itself out. Have no questions about that. As the story and the history of the Spanish flu demonstrates, these horrible events comes to pass, but it's important for all of us to look after our health and the health of others. So nothing more than that. Thank you so much.